to the live stream. I know there's a lot going on in the world right now, so I hope everyone watching is staying safe and staying healthy. Now, the reason why we do these every month is because we know that crypto taxes can be stressful, they can be overwhelming, and we wanted to make sure that all of our users had the information they needed to, understand the tax implications of their trades and be more successful crypto investors. So, with me today, I got three guests. As always, we have Jordan Bass. He's our head of tax strategy, and he's also the owner of his own crypto tax firm, excuse me, taxing cryptocurrency. How's it going, Jordan?
Doing well. How you doing, Daraj?
Doing great. Also with us, we got Miles Brooks. He's our director of tax strategy, and has years of experience helping high net worth individuals file their tax returns. How you doing, Miles?
Great. I'm doing great. Thanks, Suraj.
Yeah, and with us this week, we got a very special guest, Matt Metris. He's the owner of the firm MDM Financial Services, and he's a very great Twitter follower. I follow him on Twitter. He's got lots of great tax info. So, Matt, how's everything going today?
Hanging in there, man. Living the dream this time of year, but thanks for having me.
Great to hear. Short disclaimer before we jump into the questions here. I do want to say that this session is for informational purposes only. For specific advice regarding your specific situation, please reach out to your tax professional. Well, now that we got that out of the way, we got 28 minutes, so let's jump into this. First off, I want to start off with a piece of news that really I want to say set crypto Twitter on fire in the beginning of the month. So basically, for those of you who may not have heard of it, uh, what happened was that this couple, the Jarretts, sued the IRS because they were earning staking rewards, but they didn't believe that it should have been taxed at the time of receipt. The IRS decided to offer them a refund. So, naturally people started forming conclusions and saying things like, oh, staking rewards aren't taxed anymore. I should submit a refund too. But, if we take a closer look at the specifics, we can see that that wasn't exactly the case. So, Jordan, can you tell us a little bit more about what this case means and what it means for how staking is taxed going forward?
Yeah. To be quite honest, it doesn't really mean much. Nothing has really changed aside from a lot of people. I'm sure Matt's getting the same thing, and Miles and Daraj, the team at CoinLedger and CryptoTrader.tax, are getting inundated with requests about how to change the way that things were previously reported because of this, or a few of these articles that were put out there. But nothing has really changed. I mean, at the end of the day, there's a process that needs to be followed in order for tax policy or tax guidance or rules or regulations to actually have an impact on how we report these things. And nothing happens when somebody makes an offer or there's a compromise from the IRS and a taxpayer, a potential offer, right, to issue a refund on a particular position that was being taken. That doesn't set precedent. That doesn't do anything. And in fact, that offer was turned down. So now maybe we'll start to see something happen years down the line based off the Jarrett's case. But it's nothing that has really impacted anything from a tax perspective now, aside from people thinking that maybe they don't have to report, income from yield or from staking rewards that they've received in, 2021, 2020, dating back to 2019. It's more so a thing, in my opinion, and Matt may agree, maybe not, but I think it's just something that has added confusion to the space, specifically with investors that, maybe don't typically have that relationship with the tax professional, and they're more so filing on their own, and they're using softwares, and they want these softwares to spit out reports that say their staking rewards are not taxable. So I think, to answer the question, Daraj, it hasn't really changed anything at all, but it has caused a lot of confusion, and it has opened a conversation, at least for maybe the IRS, and facilitated some movement on the IRS's behalf to issue some guidance on these sorts of income streams, but hasn't really changed much at all.
Right. So, I earned staking rewards in the 2021 tax year. So I'm gonna have to continue reporting that as income at the time of receipt, right, Matt?
Yeah, absolutely. Like Jordan said, nothing has really changed, and I agree with everything Jordan said. It just really added confusion. It's important to note too that this is sort of a standard operating procedure for the IRS. That the amount of tax at stake here was, pun intended, was only about $3,500. So it's way cheaper for the IRS to settle than to litigate this. So they didn't even care what the merits of the case were. They would have offered a settlement no matter what you were suing for at that low amount of tax. That this is normally not an amount of tax that someone goes to court over. And the only other thing that I wanted to add is that when we say staking, sometimes we conflate proof of stake rewards, which is what is being litigated in this case, versus just regular yield. When we say we're going to stake a coin on Aave or Compound or something like that, that's not the same. It's not from a technical standpoint the same thing that's happening. So in that scenario, that wouldn't even be applicable, even if rulings came out of this case.
Got it. Miles, anything you want to add on here before we move on?
Sure. I think it's important to note that the reason the Jarretts turned down the settlement offer by the IRS is that the offer for a refund by the IRS doesn't set precedent. It didn't set any precedent, and the Jarretts, the reason why they turned down the refund and are deciding to go to court is there was nothing stopping the IRS from going after the Jarretts for that same staking income in later years. And so the Jarretts kind of declining the refund, deciding to go to court, just shows how little precedent the IRS has set by offering a refund. They offered no precedent in offering that refund on staking. So there's nothing to kind of go off of yet for how we treat staking income going forward.
Right. Maybe years from now, when that court case gets a firm conclusion, maybe things will change. But as for now, everything's pretty much the same. All right. Well, now that we got that out of the way, time to take some questions from the audience. We got a few from Twitter already. So here's one. Someone asked, can you tell us a little bit about the tax implications of taking out crypto loans? So Miles, you want to start this one off?
Yeah. This can be a little tricky. Generally, you have no tax implications from taking out a loan. This can be different though in decentralized finance if you're required to turn your ETH into something else in order to stake it as collateral. There may be a taxable event in there, but generally there is no income tax event from taking out a loan.
Right. You're saying like maybe something like Compound where you have to swap your, I might be misstating the exact mechanics, but like your ETH for CETH in order to take out the loan, that may be considered a taxable event.
Correct. That may be considered a taxable event, but again, taking out a loan in and of itself, not a taxable event.
Got it. Okay. Jordan, anything you want to add on?
No, I think, the thing that needs to be addressed really when we see these reconciliation reports from lent money to you when it's coming in on chain is sometimes, and CoinLedger and CryptoTrader.tax, it's very much going to highlight this, I'm assuming, once the integrations are there. But sometimes it looks like you have an inflow of an asset, but you don't know where it came from, or you see where it came from, but you don't establish basis in that asset. And I want to just make sure that people understand that when you're collateralizing an asset and you draw on it and you get, let's say, $25,000 USDT, let's say, you have basis in that asset. It's not like it's something where if you swap that, all of a sudden it's a zero cost basis trade. And sometimes when people are doing reconciliations on their own and they have a ton of that type of activity, it gets convoluted, and many times people will overstate income because they're not allocating basis to that money that they've borrowed. That's something that I see a lot when people come over on our end, that they're missing basis for some of these assets from their CDP positions. sometimes they're using or interacting with platforms, right, and protocols like you mentioned, Miles, like Aave, when you have the ETH to the AETH swap, and then you're borrowing against that. It can get confusing, but all in all, borrowing against your appreciated assets is something that people do in traditional equities, and it's something we have the ability to do in an expedited manner on chain. You just want to be careful that your loan to value rate is healthy and that you're actually accounting for these transactions properly, because it can mess things up. It can muddy the waters if you're, let's say, trying to internally reconcile your activity in-house rather than getting some assistance. So those complicated transaction structures are things that you want to make sure you account for and you maybe highlight before you're doing something at year end, so you look back on those. But it's it's a very valuable tool in crypto specifically, to borrow against your appreciated assets, as long as you're healthy in those positions.
Right. Sometimes, depending on your situation, it could save you some money compared to disposing of those same assets. All right, Matt, here's another question related to loans. Someone asked, what about liquidation events? Are they considered taxable?
Yeah, that would most likely be a taxable event, and that's really one of the few loan-related scenarios other than interest where you would have a taxable consequence. If you have a liquidation event, you basically dispose of that position, and you would treat it as any other, capital gain or loss event.
Right, and to my understanding, this happens even if you don't receive the proceeds of the liquidation, right? Like it goes to the platform.
Yeah, that's correct, because it could be you're being liquidated, because the value has changed too much or something like that, where you're paying off your loan basically with the liquidation. So you're still, you receive those proceeds from the loan, you have to repay them, and you're doing so by selling the property.
Got it. Okay, great to know. So here's another question that we got from Twitter. So someone asked, are transfers from wallets you don't own considered taxable? So I'm assuming this is like someone who received Bitcoin from a friend or something like that. Matt, you want to start this one off?
Yeah. So if it's a wallet that you do own, obviously that's a transfer that's not taxable. If you don't own the wallet, it's really going to depend on the nature of the transaction. In most cases, it's going to be, if you're receiving it, it's going to be an acquisition. Did you buy it? Is it establishing basis? That sort of thing. It really just falls back to, is it a gift? There's lots of different complications that can come into play there if you're getting it from a friend, for example. But the underlying nature of the transaction is what's going to dictate the taxability.
Okay, got it. Yes. Yeah, Jordan, can you tell us a little bit more about this? Like, I know that gifts aren't considered taxable in most circumstances. Is that essentially how it works?
Well, you want to be sure that the person that's giving the gift is maybe accounting for how much the gift is, right? Because they may have to file an informational gift tax return. When you have gifts coming in from foreign individuals, that can complicate things as well, that you want to make sure you account for it. Over certain dollar amounts maybe need to be reported. Gifts to foreign spouses, like there are certain rules that we need to make sure we're tracking the amount of the gift and who the gift is going to. But ultimately, unless there's like a significant gift, or somebody has given a lot of money away and used a lot of their gift tax exemption over the course of their lifetime, there's really going to be no tax consequence aside from making sure you have the appropriate information related to that gift. Meaning, somebody gifts you something, you need to know what their basis in that asset is, right? So it's more so it's not necessarily a tax impact per se. There are tax consequences. There are things that need to be understood from a tax perspective, but it shouldn't trigger any sort of liability on the end of either the giver, right, the person giving the gift, or the person receiving the gift.
Got it. Yeah, well said. And yeah, I believe the threshold for filling out that gift tax return is if the fair market value of the gift is more than $15,000. Is that right?
Yeah, it depends, right? So obviously 15,000 per person. So if I'm gifting if you're married, it's different. But if I'm gifting my cousin $20,000 worth of Bitcoin, then yes, that would require me to have to file a gift tax return. If I gift them $2,500, they need to know what that's worth, and they need to know what I acquired it for if they're going to dispose of it. But I would not be required to file a gift tax return on that dollar amount.
Okay, that's good to know. So moving along down the line here. So another question we got from Twitter, someone wanted to know a little bit about the different accounting methods you're allowed to use when it comes to cryptocurrency, like FIFO, LIFO, things like that. So Miles, can you give us a quick breakdown of what these accounting methods are, and which ones are allowed when it comes to cryptocurrency?
Yeah. FIFO, HIFO, these acronyms can seem a little confusing. To kind of paint the picture of why these methods may be necessary, imagine if you bought Bitcoin at 3 different time periods and the price has kind of increased since then. You buy Bitcoin at 5,000, you buy Bitcoin at 10,000, you buy Bitcoin at 20,000. When you eventually sell your Bitcoin, from what grouping of Bitcoin do you sell it from? That there's a calculation done to for you to recognize any income upon selling the Bitcoin, but there's gain there depending on what your basis is, what your cost basis is when you bought it. And so you have to look at, is that basis for that sale, is it that 5,000, that 10,000, or that 20,000? And so these are all the FIFO, HIFO, LIFO. These are all different methods used to determine which Bitcoin you're selling. So if you first buy Bitcoin at 5,000 and you use the FIFO method, first in, first out, when you eventually sell, it's that first Bitcoin you acquired, it's that Bitcoin you acquired for $5,000, which is used in calculation of your income when you dispose of that Bitcoin. The opposite of the FIFO method is the LIFO method, the last in, first out. And so if you use the LIFO method, you're going to look at the last Bitcoin that you bought, the Bitcoin that you bought for $20,000, and use that to calculate any gain or loss when you sell. The HIFO method is another alternative available. It's selling the highest basis tranches first. So you'll sell the highest basis. This generally minimizes your taxable income. However, something to be careful about with HIFO is there's a higher chance that you're selling short-term property, and typically for something like FIFO, you're more likely to sell long-term property, which has that preferential long-term capital gains rate. That's there's a lot there, but each strategy, FIFO, HIFO, LIFO, has their advantages and their disadvantages. And so those strategies are all viable for users within crypto.
Right. And I know that, FIFO is kind of considered the default, and that's what most investors will use just because it's considered the simplest from an accounting perspective. Is that essentially right, Matt?
Yeah, and the IRS FAQ on this tells us that FIFO is the default unless you use the specific ID method. And the requirements that they've outlined to use specific ID are pretty much identical to what goes on the 8949 anyway. So most investors are able to utilize specific ID. So when we talk about, LIFO and highest in, first out, and those other alternative accounting methods, we're really using those methods under a specific ID umbrella. Which is a nuanced difference, but you don't want to go into an audit and say I used LIFO, because that's not technically a permitted accounting method. You use specific ID, and so far that's a real advantage for crypto investors, because if you were to trade securities, you need to identify the lot that you're selling at the time of the sale. So if I'm selling my Google stock, I need to tell my broker I want to sell the lot that I bought on date X instead of the one I bought on date Y. And at least under the current landscape with crypto, I can't tell the exchange which lot I'm selling. So we currently have the flexibility to look at it in more of a retrospective picture and, do what's most advantageous.
Got it. Jordan, anything you want to add on here? Jordan, your audio's gone. Oh no. Oh well. Let's see if he can figure that out. Oh, well, we lost him. All right, well, we'll continue with the questions while he figures out those technical difficulties. All right, Jordan, I see you. I still can't hear you. Well, you can continue working on that in the background. Let's see our next question. Jordan says he got rugged in our private chat. That's pretty funny. So someone asked about 1099 forms and how that works and how you can use those to fill out your tax return. Someone else in our YouTube chat asked, I use FTX and they don't report my earnings. Do I technically have to report them? So I guess it's good to kind of go over the basics of, how 1099 reporting works and, how you can use that information and whether you should report that information, even if you don't receive one. So Matt, could we start with you this time?
Sure. Yeah. 1099s affectionately are a dumpster fire in the crypto space right now. Every exchange is doing something completely different. We know from the infrastructure bill that passed in November that 1099 reporting will be mandatory for the 2023 tax year. So that's not going to help us this year or next year. You are 100% required to report your income whether or not you receive a 1099. It's not just crypto, that applies to literally everything. The 1099 is an issue between the exchange and the IRS to file it or not file it. You need to report your trades, absolutely. Now that said, different exchanges are reporting different forms. We see 1099Bs, we see 1099Ks, we see 1099 miscellaneous, and they're all reporting different types of income. The B is the one that we're most familiar with from a stock trading kind of standpoint, and that should have decent information, but you still should be maybe suspect of the basis if the basis is being reported and it's exchange where you can transfer coins on and off that exchange. If it's something like Robinhood where you can't, then the basis is probably pretty accurate. The Ks are a giant mess, and they also have issues with the fees being included when you don't include the fees on the 8949. I don't want to get too far in the weeds on that. And the miscellaneous ones you see when you do things like earning, staking on the exchanges and things like that.
Got it. And just to touch on that transferring problem that you mentioned with 1099Bs, I guess the issue here is, I don't know, let's say I bought $500 of Bitcoin on FTX and then I transfer that to Coinbase. Coinbase wouldn't know my original cost basis, right?
Yeah, exactly. And in the new law, so starting in 23, FTX will be required to tell Coinbase what you bought it for. But if you were to buy it on FTX, transfer it to your own ledger, and then transfer it to Coinbase, that information would still be missing.
Got it. Yeah, I imagine it's a nightmare for a lot of DeFi protocols as well. Jordan, you got your audio back?
I don't know. Do I?
Yes, you do.
Yeah.
Let's go. Yeah, I think I heard everything that Matt was saying, and I agree with him, everything that he said about the 1099s. There's a bevy of different 1099s that people receive in traditional, tax documents, and that kind of carries over to crypto early on in 17 and 18, and even some parts of 2019. Those 1099Ks were a disaster. We had plenty of clients that the IRS would just see the total volume, the velocity of their transactions based on something filed by Coinbase, and they would get a notice saying they owe millions and millions of dollars of tax when in fact they were operating at a loss. So those forms kind of suck when we're talking about crypto, but obviously as time has gone on and the infrastructure is being built out, in theory, what people will start to receive, like Matt was saying, should be a little more accurate-ish. But if you are dealing with any unhosted wallets, if you're dealing with a lot of on-chain transactions, specifically NFTs, there's no way that basis allocation from those centralized exchanges will be accurate. Now, CoinLedger might know what your basis is, right? If you import everything in there, but the centralized exchanges wouldn't. So those software solutions are going to come into play, and they're going to be very, very valuable for tax professionals like us and for individuals as well. And that's really all that people can do in their best effort to report this activity, because just like Matt was saying, whether you receive a 1099 or not, income is income. And if you're generating income, you want to report that income, or else you might, there might be a world of trouble down the line, whether that's a year from now, 2, 3, 4 years, who knows? But ultimately, especially with crypto, it will catch up to you. I've seen it many, many times. So that's not trying to scare anyone. I'm just saying, income is income. Report that income, pick it up, do your due diligence, find someone that can help you that fits, find the software solution that fits with what you need, so that you can report this activity and not be in trouble with the IRS. No one wants that.
Well said. Well said. Miles, I want to give this next question to you. So someone asked, for the following taxable events, mining, trading from one cryptocurrency to another, or receiving a crypto reward, do you claim sorry, I want to make sure I'm reading this right. Do you claim when receiving crypto at fair market value, or only when it's transferred to fiat? So I know there's a few different things in there. So yeah, let's go through that.
Great. Yeah. Specific to like the mining, airdrops, earnings, anytime you have earnings or you have income come in, the standard way the IRS treats that is they're going to treat it as income when it's received. You do not have to wait till a disposal event or for you to transfer that crypto into fiat. The income event happens when it is received, when you have control and you can trade or sell those tokens. On the other side of that, when you're trading tokens, you'll have a disposal event, whether you're trading your crypto to fiat, whether you're trading your crypto for another crypto, or whether you're kind of using your crypto to pay for goods or services. So that will also create a taxable event kind of on the trade and exchange side of things.
Got it. And Matt, anything you want to add on there?
Yeah, the only thing I would add is we have a concept in accounting and taxation called constructive receipt, which is recognizing an income event when you could access the income, not when you actually do. And there's a great analogy if you're a landlord and the rent check is sitting in your mailbox on December 31st, and I don't go out to my mailbox and get the mail, that's still income to me. But if it was stuck in the postal service on December 31st, I wouldn't recognize that income till the next year because I couldn't access it if I wanted to. And there's a lot of times in crypto where we don't know how constructive receipt is going to apply. When we think of like airdrops, is it the block that the airdrop happened, or is it when I click the claim button? And that can have big impacts, and there's obviously a conservative and more aggressive position on that. It was just something to keep in mind when you're deciding what income to recognize and when.
Yeah, definitely a complicated issue given how, especially a lot of these staking mechanisms work. So we got 2 minutes. Let's see what else we've got. So we got a couple of questions on airdrops and how those are taxed. So Jordan, I guess someone asked specifically about what if it's like a scam airdrop, where it's specifically meant to, you accept it and it drains the funds out of your wallet. What would you do for something like that from a tax perspective?
Well, that would not be ideal. I can tell you that. Usually what we do when we see, I don't know specifically scam airdrops where you interact with some sort of smart contract or some wallet address and it can drain the funds. But when we see airdrops from like marketing coins or tokens that are really non-existent, there's no real market for it, and they come into the wallet, what I do personally, and I don't know if Matt does something similar, but we disregard those. We effectively treat them as these tokens are blacklisted from this reconciliation. There's really no market value for this asset. Even if there was a small liquidity pool spun up by someone and there's like a fake market price, it's not real, and we'll disregard that. And I don't think that there's any issue in doing that. I, in fact, think that's the proper way to do it. If you're going to interact with some sort of contract and somehow your funds get drained and it's like a theft loss or a casualty loss, really, you're not going to like the answer, but there's really not much that you can do in that sense. So protect your wallet, protect your keys, and don't let that happen. Obviously, maybe sometimes there are certain transaction structures where it looks like you may have swapped something for something of no value, and therefore maybe you can deduct a loss, maybe. But when you're dealing with, these issues of someone draining your wallets, it's not a fun situation to be in, because really the tax code doesn't provide a good solution for that. And in fact, the real solution is no solution at all, where you can't really do much since 2017. And it's unfortunate, but it's the case.
Well said. Well said. So do you guys have time for one last question?
Of course.
All right. So we got a couple of questions just about rug pulls, and whether it's a cryptocurrency or an NFT that goes to zero and you're stuck with the bag. What should you do in that case? Can you report that as a capital loss? Miles, want to take this one on first?
Yeah. I think these situations where the value of your investment, it kind of goes to $0 or close to it, is a little different than the casualty or theft loss situation. If your assets are actually worth $0, you can claim that. You can kind of claim that loss when you realize that loss, and so you'd have to have a realization event. You'd have to either trade your $0 NFT for something else. You'd have to sell your tokens that are worth close to $0 for something else in order for you to realize and recognize that loss.
Okay, got it. Matt, any tips out there, tax tips for people who got rugged?
Yeah, I mean, Miles summed that up real well. I know there's services out there, especially NFT related, that'll buy your illiquid NFTs for like 1 gwei, and so you can realize that loss. And I don't know specifically if there's any for other tokens, but there's ways of, just make sure that you don't engage in something that is not bona fide to do that. I've seen clients come to me and be like, "Oh, I'm going to sell it to my friend for $1 and then buy it back," and all. You don't want to engage in any sort of thing that's not arm's length, where you're orchestrating something for tax purposes. The IRS is definitely going to frown upon that.
Got it. That makes sense. Jordan, any closing words for us to take away?
Closing words. If we're going to stay on the rug pull topic, I just want everyone to be safe, not just obviously in the markets, but be safe wherever you are in the world. You don't want any issues. We don't want to see any issues like that. Crypto comes second when we're dealing with a lot of these things. So protect yourself, protect your family, protect your coins. Don't get rugged, right? But just want everyone to enjoy the rest of their weekend, and we'll probably sync up sometime next month. We'll have some new updates for you.
Awesome. Yeah, and we got a big update coming as a company very soon. I don't think I'm allowed to say more than that at this point, but so if you're interested in getting started with CryptoTrader.tax, you can click the link in the description to get started with the free preview report. And before we end this, I'd love to just know how the audience could reach each one of you. Matt, you want to get started? How can somebody reach out to you?
Sure. My website is bitcointaxes.me, a little pun in there, and all my contact information is there.
Awesome. Jordan, how about yourself?
Yeah, website taxingcryptocurrency.com, or if you want, you can message me on Twitter. Pretty active on crypto Twitter when I can be. So those would be the best places to reach.
Awesome. Miles, how about yourself?
Yeah, you can check me out at Miles Brooks Tax on Twitter. That's the main way to reach me. Otherwise, check out CryptoTrader.tax to get your taxes done, your crypto taxes done through our software.
Yeah. Link in the description. You forgot the most important part. Well, thanks everyone for tuning in. We really appreciate it, and I will see you all next month.